It's 9 in the morning and your savings just lost half their value. Not over a year, not over a month, since yesterday. This isn't a thought experiment. This isn't a worst-case scenario from some economics textbook. This is what 1.5 billion people across history actually lived through. And every single time, in Germany, in Zimbabwe, in Venezuela, in Hungary, people made the same desperate move. They ran to gold. And a shocking number of them still lost everything. That's the story nobody tells you. Everyone talks about gold as the ultimate hyperinflation hedge. Buy gold, protect your wealth, survive the collapse. It's practically financial gospel at this point. And it's not wrong. Gold has preserved wealth through some of history's most catastrophic monetary events. But here's the part that gets left out of every gold commercial and every finance YouTube channel. The people who bought gold at the wrong time, in the wrong form, in the wrong amount, didn't just fail to protect their wealth. Some of them accelerated their own financial destruction. There is a specific, documented, historically repeated mistake that ordinary people make when they panic buy gold during a currency crisis. A mistake that feels completely rational in the moment. A mistake that financial advisors rarely warn you about because most of them have never lived through actual hyperinflation. And right now, with inflation data being revised upward, central banks buying gold at record levels, and currency confidence quietly eroding across multiple major economies, this is possibly the most important financial education video you will watch this year. Because here's the brutal truth about hyperinflation that changes everything. By the time most people realize what's happening to their currency, really realize it, in their bones, in their grocery bills, in their savings account, the window for smart action is already closing. In Weimar Germany, the people who protected real wealth weren't the ones who panicked in 1923 when the wheelbarrows came out. They were the ones who understood something critical years earlier. Something about gold and silver that goes completely against the instinct every human being has during a financial crisis. Something that, once you hear it, will permanently change how you think about precious metals. But to understand the mistake, you first need to understand what hyperinflation actually does to a person. Not financially, psychologically. Because the mistake isn't really about gold at all. It's about fear. And what fear does to perfectly intelligent people when their money starts dying in their hands. Here's what they never tell you about hyperinflation. It doesn't feel like a crisis at first. It feels like inconvenience. Prices go up a little faster than usual. You notice it at the grocery store. You notice it at the petrol pump. You mention it to a friend and they agree. Things are getting expensive. The government releases a statement. Officials say it's temporary. Economists argue about the data. Life continues. This is the most dangerous phase of every hyperinflationary event in history. Not the wheelbarrow phase, not the burning currency for heat phase. This phase, the phase where everything feels slightly wrong but not yet catastrophic, the phase where action is still possible but urgency hasn't arrived yet. Because here's what's happening beneath the surface during that deceptively calm early phase. The people who understand monetary history are quietly, methodically converting paper wealth into tangible assets, gold, silver, land, productive assets. They're not panicking, they're not posting about it online, they're just moving. Steadily, deliberately, while the currency still has enough purchasing power to buy something real with it. In Weimar Germany, this window lasted roughly from 1919 to 1921, 2 full years where a person with savings and awareness could have protected almost everything, 2 years where gold and silver were still reasonably priced, 2 years where the exchange rate was unfavorable but not yet catastrophic. By 1922, the window was closing. By late 1923, it was gone. Now here's where the gold mistake enters the story. By 1922, when ordinary Germans finally started to panic, gold prices in marks had already begun their exponential climb, not because gold had become more valuable, but because the mark had become less valuable, and people were finally waking up to that fact all at once. What happens when millions of people simultaneously try to buy the same limited asset? The price of that asset, measured in the dying currency, goes vertical. A German worker who waited until 1922 to buy gold didn't just pay more marks for the same ounce. They paid more marks for the same ounce while their purchasing power to buy those marks had already been devastated. They were buying protection with currency that was already half destroyed. And this is only the first layer of the mistake. There's a second layer that's even more dangerous, a third layer that almost nobody discusses, and a fourth revelation about silver, specifically silver, that completely changes the calculus of precious metals during currency collapse. But to get there, you need to understand what actually happens to gold's purchasing power during the peak of a hyperinflationary event, because it doesn't do what most people expect, and what it actually does will genuinely surprise you. Everyone assumes gold goes up during hyperinflation. And in nominal terms, in the dying currency, yes, absolutely. An ounce of gold that cost 170 marks in 1919 cost 87 trillion marks by November 1923. So technically, gold went up enormously. But here's the question that matters. Did gold preserve purchasing power, or did it just go up in numbers while the numbers themselves became meaningless? The answer is complicated. And the complication is where ordinary people get destroyed. Gold does preserve purchasing power through hyperinflation, but only if you can hold it through the entire event and convert it back to real assets at the right moment on the other side. That sounds simple. In practice, for ordinary families living through the collapse in real time, it was anything but. Here's what actually happened to many German families who bought gold. They bought it late, in 1922 or 1923, with already weakened purchasing power. They bought it in large denominations, full gold coins, because that's what was available and that's what felt substantial and safe. And then the crisis deepened faster than they expected, and they needed to buy food. A full gold coin in 1923 Germany was worth an enormous amount of rapidly inflating marks, more marks than most families needed to buy groceries for a single day, which meant to buy bread, to literally survive, they had to sell the whole coin and receive a mountain of marks in return. Marks they then had to spend immediately before the value evaporated. This is the liquidity trap, and it has caught gold buyers in every hyperinflationary event across modern history. The asset is too large to spend, too valuable in one unit to use for daily transactions, and the alternatives, selling to dealers, finding buyers, navigating black markets, all come at massive discounts and dangerous delays. This is exactly where silver enters the story, and this is where the history gets fascinating. Because the families that navigated Weimar Germany's collapse most successfully, the ones documented by historians who studied survivor accounts decades later, weren't the ones with the most gold. They were the ones with the right ratio of gold to silver, and specifically the right forms of silver. Small silver coins, divisible, spendable, exchangeable for exact amounts without losing value to change-making discounts. Silver that functioned like the small denominations of a parallel currency running alongside the dying mark. But here's what makes this strategy genuinely dangerous in the modern context. Because silver in hyperinflation doesn't just behave differently than gold, it behaves differently than silver in normal economic conditions. And the difference could mean the gap between protecting your family's wealth and watching it disappear through a completely unexpected mechanism. A mechanism that is hiding in plain sight in today's silver market right now. There's a concept in precious metals that almost nobody outside of serious numismatic and survival finance circles talks about. It's called the gold-to-silver ratio, and during hyperinflation, it does something that defies every intuition a rational person has. In normal economic times, the gold-to-silver ratio fluctuates between roughly 60 and 80, meaning 1 ounce of gold buys between 60 and 80 ounces of silver. It has operated in this range for most of modern financial history. But during currency crises and hyperinflationary events, something strange happens. The ratio compresses dramatically. In Weimar Germany's worst months, the practical exchange ratio between gold and silver in street-level transactions dropped significantly from its pre-crisis levels. Silver, precisely because it was more usable, more divisible, more accessible for everyday transactions, commanded a premium in real purchasing power terms that its nominal price didn't reflect. People needed silver more than they needed gold in the daily economy of collapse. And here's the investment implication that almost nobody acts on before a crisis. If you buy silver when the gold-to-silver ratio is historically high, meaning silver is relatively cheap compared to gold, and hold it through a currency crisis where silver's practical utility drives the ratio down, you don't just preserve wealth, you potentially increase it in real terms. This is not a fringe theory. This is documented behavior across multiple historical hyperinflationary events. The ratio compressed in Weimar Germany. It compressed in Zimbabwe. It compressed in Venezuela as informal precious metals markets emerged outside the official banking system. But here's the mistake people make even with this knowledge. They buy silver ETFs, paper silver, digital representations of silver sitting in a vault somewhere that they have a legal claim to on a spreadsheet. During normal times, perfectly reasonable, cost-efficient, liquid, easy. During a genuine currency crisis, potentially worthless, because in a hyperinflationary environment, the financial infrastructure that makes paper silver function begins to strain and sometimes break. Counterparty risk, the risk that the institution holding your silver cannot or will not deliver it, goes from theoretical to very real, very fast. Zimbabwe's currency collapsed over years. In that time, foreign bank accounts became inaccessible. Digital assets became unrecoverable. People who owned silver on paper owned nothing that could buy bread. The people who survived financially held physical metal in their hands, in their homes, in forms small enough to spend. And this brings us to the final and most counterintuitive piece of the entire gold and silver strategy during hyperinflation. The piece that explains why even people who did everything right, bought physical gold, bought physical silver, held it through the collapse, sometimes still made one final devastating mistake on the other side of the crisis. A mistake that happened not during the hyperinflation, but in the 48 hours after it ended. November 15, 1923. The German government introduces the Rentenmark, a new currency, backed, symbolically at least, by land and industrial assets rather than gold. One Rentenmark exchanged for 1 trillion old marks. Overnight, the hyperinflation stopped. Not gradually, not slowly, overnight. And here is where the final, devastating mistake happened to people who had done almost everything right. After months, sometimes years of watching their paper marks become worthless, of scrambling for food, of navigating the terrifying daily reality of a dying currency, they finally held something real. Gold, silver, tangible, physical, life-saving metal. And the moment the new currency arrived and stability appeared on the horizon, they sold. Immediately, desperately, relieved beyond description to have real money again, exchanging their gold and silver for the fresh, clean, trustworthy new Rentenmarks, finally able to breathe, finally able to plan, finally feeling safe. What they didn't know, what they couldn't have known in that moment of exhausted relief, was that the Rentenmark itself was a temporary bridge. That Germany's monetary problems were not solved in November 1923. They were postponed. And the deeper economic instability that would eventually produce Adolf Hitler's rise to power was already baked into the system. The gold and silver they sold in relief in late 1923 would have made them extraordinarily wealthy in real terms through the relative stability of the mid to late 1920s and the subsequent crises of the 1930s. They survived the hyperinflation, and then they gave away the reward for surviving it. This is the final layer of the gold mistake, the one that completes the full picture. Buying too late, buying in the wrong form, holding paper instead of physical, and then selling too early, at the first sign of stability, before the full value of holding through the chaos could be realized. So what does all of this mean for someone sitting here in 2025 watching this video? It means the time to think about this is now. Not when inflation hits 20%, not when the currency starts making headlines. Now. While gold and silver are still priced in a currency that has not yet begun its terminal decline. While the ratio between gold and silver still offers a strategic entry point. While physical metal can still be purchased without premiums driven by panic. The families who came out of Weimar Germany's collapse with real wealth intact were not the smartest people. They were not the wealthiest people going in. They were the most prepared people. The ones who understood what money actually is. Not a government promise, not a number on a screen, but a store of real human effort and real productive value. Gold and silver have stored that value for 5,000 years. Through the fall of Rome, through Weimar Germany, through Zimbabwe, through Venezuela. They will store it through whatever comes next. The only question, the same question this video has been asking from the very first second, is whether you will be holding them when that moment arrives, or whether you'll be the person at the baker's gate, watching the price change, wishing you had moved sooner. The window is always open, until it isn't. If this changed how you think about gold and silver, share it with one person who needs to hear it. Not because the sky is falling, because preparation is not panic, it's wisdom. And wisdom has always been the rarest asset of all.